In this week's video, I'm going to share with you guys 3 reasons why I think trading futures is much better than trading stocks. Stay tuned. Hey, welcome back to YouTube. If you're new to my channel, my name is Mike Swartz, trading coach at epitomytrading.com. And if you're new to my channel, hit the subscribe button down below. It means a lot to me. So today I'm going to share with you guys the 3 reasons why I think trading in the futures market is much better than trading the stock market. So let's go ahead, let's jump into the slides that I have for you, and let's see if you guys agree with me or not. All right, so the first reason number 1 is going to be margins. And what I did for this is I used the SPY ETF, which is an ETF for the S&P 500. Now, the current price as I'm recording this when it closed on Friday was $229.40 per share. Now, in the stock market, most brokers allow you 2-to-1 leverage, meaning that you only have to put up 50% of the money. So here's what the margin cost would be. It would cost you $114.70 per share. Now we're going to do this on a 100 share increment to kind of make it, kind of close. So 100 shares at $114.70, your margin cost would be $11,470. Now that's a lot of money. Most traders that are just starting out don't have $11,000 to put on a trade. Now, in the S&P 500 futures contract, all right, the closing price was $2,266.50. Now, the margin cost to day trade this is only going to be $500. Now, you can see that's a big difference, right? I can get involved in the futures market with as little as $500 to put the trade on, where in the stock market, it's going to cost me $11,470. That's just, reason number 1. And drop a comment below. Which of these sound better to you? Would you rather put up $11,000 to put a trade on, or would you rather put up $500 to put a trade on and get involved in these markets? Now let's look at reason number 2, right? We're going to talk about percent gain or loss, all right? So we're going to assume the S&P moves 10 points. With 100 shares of the SPY, that's only going to be a gain or loss of $100. All right, now what about percentage? Well, $100 divided by 11,470 is going to be less than a 1% gain on that capital that you put up for that trade. Now, a 1 ES futures contract, it's going to equal that same 10-point move is going to equal a $500 gain. All right, so 500 divided by 500, that's going to be a 100% gain or loss. Now, let's think about this. In trading, our results all boil down to percentages, right? How much we get to keep, how much percent can we make on this money that we're putting up for this trade. So in the stock market, we're going to make less than 1% if we get the move right on the S&P 500, a 10-point move. That same 10-point move in the futures market, we're gonna make 100% gain on the margin that we had to put that trade on. Now, to me, that sounds like a no-brainer because it's the same point movement in the market. Now, the downside is, all right, let's talk about the downside, because on the plus side, yes, we would make 100% gain, but on the downside, we could also lose 100%. So if we put $500 up, we could also lose $100 or 100%. We lose $500, where a 10-point move in the S&P that went against us, meaning that we picked the wrong direction in the market, we'd only lose a little bit less than 1%. All right. So keep that in mind. Just because, this is 100% that you can make on the money, you could also lose 100% if you got that 10-point move wrong. Now let's look at the next one, short sales. All right, stocks, especially low float stocks, they might not be shortable. There might not be no shares available for you to sell. So let's think about this. How terrible would this be that you do all your analysis on, stock ABC, and I just made up that term, so don't go trade ABC stock. But you go look for shares of this company, you get the chart pattern right, you're like, yes, I'm going to short it. The market drops and you could never take advantage of this because your broker was unable to locate shares so that you could short. Guess what? In the futures market, we don't have to worry about that. We just simply hit boop, sell, we're involved in the market. That simple. Now, I don't think you'd have problems trying to find shares to short of the SPY like we just showed in the last example. It's a very liquid ETF, but it is something to think about when you're trading stocks versus the futures market. Futures market, that's one less thing that we have to worry about. All right, we don't have to worry about the broker locating contracts so we can short it. We just simply hit sell short, we're good to go. Now, tradable hours. Now, this is very important, especially for expiring traders, new traders, or, individuals that were looking to be traders in the future. You want to look at tradable hours, all right? Stock trading hours, the stock market opens at 9:30 a.m. and closes at 4 p.m. Now, I should have had, an a.m. right after here. That was a little typo on my part. Again, I'm not perfect. The stock market trades 5 days a week, 6.5 hours per day. So you have 6.5 hours to look for opportunities in the stock market. Well, if you think about this, most 9 to 5 jobs, right? 9 to 5, you're at work before the market opens and you leave work after the market closes. So you're kind of shut out from a lot of opportunities in this market. The futures market, it trades from 6 p.m. until 5 p.m. the following day. So let's say Sunday night at 6 p.m. the market's going to open. Well, the futures market's going to close down at 5 p.m. on Monday. And it's not going to reopen until 6 p.m. on Monday. So the futures market does close down for 1 hour, from 5 p.m. Eastern time until 6 p.m. Eastern time, right? That 1 hour. So the futures market's going to trade 5 days a week or 23 hours per day. Or should I say 5 days a week, 23 hours per day. So you can see there's a lot more opportunities where we could find, trading hours that fit our schedule. So if you have a 9 to 5 job, hey, guess what? You can still look for swing trades and adjusting positions and whatnot, after hours, after you're home from work, while you're on your lunch break, before you go to work. There's a lot more opportunities and ways for you to get involved in the market. You don't simply have to wait until 9:30 a.m. to get involved. Now, I know some of you guys that trade stocks are probably going to beat me up in the comment section below. Mike, you can trade before and after hours. That is absolutely correct. The stock market, some brokers will let you start trading at 8 a.m.-ish. And they'll let you trade to, I think, 6 p.m., 7 p.m., maybe even 8 p.m. The problem with that is because there's not that much trading activity taking place, the spreads between the bid and the ask, they tend to widen out. You also have a hard time getting filled. You get more slippage during those hours. Where in the futures market, that's not as much of an issue. Yes, the volumes do dry up a little bit, but there's still enough activity to where you can get in and out of a position. The spreads aren't crazy unless there's some kind of crazy news going on, but still, in the futures market, the spreads stay pretty well maintained most of the time. Now, the last 2 weeks, volatility has been crazy out here in these markets, given the fear of the coronavirus and all the other bad news going on in the world with businesses having to shut down due to the coronavirus. We've had an extreme amount of volatility, but it's also been a time for great opportunities out there in these markets. All right, now one last thing we want to look at in terms of futures, and I know this doesn't have to do with stocks, but you may say to yourself, Mike, I don't have $500 of margin to put up for the ES. And with the ES at $500 margin, each tick against you or in your favor is going to equal $12.50. Where the MES contract, which is identical to the ES in terms of what the price chart is going to look like, is only going to cost you $50 margin to put up. And then one tick is going to equal $1.25. So those of you with smaller account sizes that want to participate in the movement of the S&P 500, the MES contract is a great alternative to the ES. And even if you want to eventually trade the ES, maybe you do have a large account size and you want to just trade the ES, but you've never traded the futures market before. The MES is a great product to help get your foot in the door and kind of learn the movements of the S&P 500 with little or limited risk. All right. meaning that the risk is not going to be as great as if you're trading the ES futures contract. And we're going to jump to the charts real quick. I'm going to show you the difference in the two charts. So let's go ahead and jump back over and take a look at the charts. All right, so here we are. We're looking at a chart of the ES on the left and the MES on the right, and we're simply looking at a 5-minute time period. Now look at the charts. Don't they look very, very similar? You would trade them exactly the same, except for the chart on the right, you're gonna have a lot less risk, a lot less margin that has to be put up on that trade. So to put a trade on the chart on the right, it's gonna cost you $50 of day trading margin. Chart on the left, it's going to cost you around $500 of day trading margin. And the chart on the left, if you're wrong, you're going to lose $12.50 per tick. And you might say, what's a tick? Well, essentially there's 4 ticks and a point. So the ES is going to trade in quarter point increments. You can see 2266.50. All right, so the next 1 tick up will be 2266.75. That would equal a gain of $12.50. And even look at the closing price on each of these charts, exactly the same. 2266.5, 22, oh no, they're 1 point off, 2265.50. So they're off by 1 price point. I want to see where it actually closed. 2665.50, and yeah, so they're off by one point, but the moves are going to be roughly the same. I just want to mark this off real quick. I just want to do this for my own fun. How big was this move up here? Roughly 48 points. And oops, right up here. 48 points. So you can see the distance of the moves are identical. The patterns are identical. The only thing that's different is how much money you need to put up to put on the trade and how much you're going to lose or make if you're right or wrong on the trade. Like always, hope you guys enjoyed today's video. Don't forget to give it a thumbs up if you enjoyed the comment. Until next time, good luck and good trading.